Okay, so what if I told you there's this powerful, often overlooked secret weapon in the world of business taxes?
Hmm.
A tool that lets your business earnings flow right to you, potentially saving you, like significant tax dollars, and bypassing some of those huge corporate tax headaches.
Sounds interesting.
Well, buckle up then, because today we are diving deep, really deep into the intricate, incredibly valuable world of S corporations. We're going to uncover those advanced strategies that can truly impact your bottom line.
Yeah, keep more of your money.
Exactly. Keep more of your hard-earned money right where it
Yep.
belongs, in your pocket.
Indeed. And, many entrepreneurs, small business owners, they get the basics of S Corp. They understand the general idea.
Right.
But the real power, the genuine tax efficiency,
Mm.
and like the ability to proactively manage your tax burden, that lies in understanding the, let's say, advanced nuances.
Yep.
So today, we'll try to strip away some of that complexity. Focus squarely on the critical areas, the things that can translate directly into, well, significant tax savings and strategic financial moves for you, the learner.
Okay, let's unpack this then. We've got this stack of really fantastic sources on S Corporation advanced topics. And our mission, our goal today, is to pull out the most potent nuggets of knowledge, those aha moments,
Right, the insights.
Yeah, the things that make you rethink your whole financial strategy, and the practical insights that empower you, our listener, to leverage your S Corp for maximum tax advantage. We're talking sophisticated ways to manage your tax obligations, not just, file them at the end of the year.
Exactly. Proactive, not reactive.
So to start us off then, maybe for anyone who's kind of new to this S Corp universe, or
Okay.
just needs a quick refresher, what exactly is an S Corporation? And why do people keep calling it a superpower for tax efficiency? What's that core thing?
Right. So at its core, an S corporation is basically a small, closely held corporation, but it's made a special choice, an election with the IRS, to be taxed differently than your standard corporation.
Okay.
Instead of being taxed like a typical C corporation, it gets treated more like a partnership for tax purposes, which means it operates as a flow-through entity.
Self-opener.
Yeah. And the fundamental concept, which really is its superpower, is that all of the corporation stuff, its income, gains, losses, deductions, basically all its tax characteristics, they flow directly through to the shareholders,
So straight to the owners.
straight to the owners.
Mhm.
And as the individual owners, you are then taxed on your proportionate share of the S Corp's earnings. But here's the key. Only once. At your individual income tax rate. And it doesn't even matter if the earnings were actually distributed to you in cash yet.
Ah, okay. So if I'm getting this right, it's really all about dodging that infamous double taxation that C Corp deal with.
Exactly.
Like with a C Corp, the company pays corporate tax first.
Right.
And then when they pay dividends out of what's left, the shareholders pay tax again on those dividends. That just sounds painful.
It can be. That's 2 layers of tax on the very same income. But with an S Corp, like you said, it's just the one layer, directly on your personal return.
Wow. That is a huge difference for the bottom line. Puts more cash in your pocket right away.
Hmm.
So how does a business even, become an S Corp? Is it automatic when you incorporate?
You absolutely nailed the key difference there. That single layer of tax is a massive advantage, especially for small and growing businesses. But to your question, no, it's definitely not automatic.
Okay.
By default, when you first form a corporation, it's automatically treated as a C corporation for tax purposes. It only gets that S corporation status if you file a valid S corporation election. That's IRS Form 2553. You have to properly file it with the IRS, and they have to accept it.
So it's a deliberate step.
It's a specific proactive step you, the business owner, need to take. It basically tells the IRS, hey, tax us as a flow-through entity, please. Now, when it comes to putting assets in initially, like contributing property for stock, the gain or loss calculations for both the corporation and the shareholders are pretty much the same as they'd be for a C Corp.
Okay.
And that actually brings us right into our next critical point, especially for tax efficiency right from the start.
Right, let's talk about that initial stage, getting started. Specifically, when shareholders put property, maybe equipment, land, even intellectual property into the S Corp in exchange for stock.
Mm-hmm.
I hear there are some very specific rules here that can have a huge impact on whether you get hit with an immediate taxable gain,
That's exactly right.
which I imagine you really want to avoid right out of the gate. No surprise tax bills, please.
Absolutely. And this is where a really important piece of the tax code, Section 351, comes into play. It governs how shareholder contributions to an S corporation are taxed, and it works the same way for S Corp as it does for C Corp.
Section 351. Got it.
And the big goal for most business owners here is to make that initial property contribution a non-taxable event. Meaning, you don't trigger an immediate tax bill just by moving an asset you already own into your new S Corp.
Okay, so how do you make sure it is non-taxable?
Yeah.
What are the magic conditions?
Well, there are 3 crucial conditions you absolutely have to meet. Miss even one, and boom, you could have an unexpected tax liability.
Okay, 3 conditions. Lay 'em on me.
First, you have to contribute property. And it's important to note, services generally don't count as property for this tax-free treatment. You can still get stock for services, but that usually has immediate tax implications.
Okay, property, not services. What's under 2?
Second, you have to receive solely stock in exchange for that property. If you get anything else back, cash, other assets, even certain types of debt relief that aren't managed carefully, that's called boot.
Boot. Like kicking boot.
Maybe. But in tax terms, boot can trigger a taxable event, at least partially.
Okay, so just stock, no boot. Got it. What's the third one?
Third, and this is a big one, a major planning point that often trips people up. Immediately after the transfer, the shareholder, or a group of shareholders doing it all together in one integrated plan, must collectively have 80% control of the corporation.
80%. Okay, what does control mean exactly?
It means owning at least 80% of the total combined voting power of all stock that can vote, and at least 80% of the total number of shares of all other classes of stock. Basically, you need supermajority control right after the property goes in.
Wow.
Yeah. If you don't meet that 80% threshold, even if you met the other 2 conditions, your contribution could be treated as a taxable sale instead of a tax-free contribution.
Okay, this is where it gets really interesting and directly hits your wallet, right?
Yeah.
That 80% rule sounds like a huge make or break point. Can you walk us through an example, maybe one where someone didn't hit that 80% and got a surprise tax bill?
Definitely.
And then maybe contrast that with someone who did plan it right and had a real tax-saving win. This feels like where the strategy really pays off.
Absolutely. Let's look at example 1. We'll call him Ray. Ray contributed property that had a fair market value, or FMV, of $20,000. His adjusted tax basis in that property, what he had in it for tax purposes, was $10,000.
Fine.
He transferred this property in exchange for stock in an existing S corporation, let's call it Falcon Corporation. Now, the problem was, immediately after this transfer, Ray only owned 20% of Falcon stock. The other 80% was already owned by others.
Oh, only 20%. Not good for the rule.
Exactly. So even though he realized a $10,000 gain on paper, that's the $20,000 value, minus his $10,000 basis, he was required to recognize that entire $10,000 gain for tax purposes.
Ouch. So he had to pay tax on $10 right away.
Right away, because he
Oh.
didn't meet that critical 80% control threshold. So that's an immediate $10,000 taxable gain he has to report, an unexpected tax bill just for joining the company.
Wow. Okay.
And his basis in the Falcon stock, looking forward, would then become $20,000, his original $10 basis, plus the $10K gain he just had to recognize.
Okay, so that's the pitfall. Now show us the success story. How did someone else nail this?
Okay, let's contrast that with example 2. We'll call her Roberts. This really shows the power of planning. Roberts contributed property with an adjusted basis of $100,000 and a fair market value of $200,000. So appreciated property again.
Right.
But here's the key. She did this in exchange for 100% of the stock in a newly formed S corporation, also called Falcon Corporation. And importantly, Falcon Corporation also assumed a $70,000 mortgage that was attached to the property Roberts contributed.
Okay, 100% control of a new company. And debt involves. How did that play out?
Well, Roberts technically realized a gain of $30,000 in an economic sense. You calculate that as the $200,000 fair market value minus the $70,000 debt the corporation took over, less her $100,000 basis on the property. Leaves $30,000 of realized gain.
Okay, 30K gain realized. But did she have to recognize it?
And here's the big win. 0 gain was recognized for tax purposes.
0.
Because the exchange perfectly met all 3 Section 351 conditions. 1, it was property. 2, she got solely stock no boot. And 3, she owned 80% or more immediately after. In fact, she owned 100% because it was a new corporation.
The new corporation part was key.
And crucially, the debt the corporation assumed, that $70,000 mortgage, did not exceed her adjusted basis in the property, which was $100,000.
Okay, what if the debt had been higher than her basis?
Good question. If the debt assumed had exceeded her basis, that excess amount would have been treated as boot, and that would have triggered a taxable gain. But here, she stayed under that limit.
So she navigated it perfectly.
Perfectly, which means she achieved a significant $30,000 tax deferral right at the very start of her business. Her basis in the Falcon stock moving forward would be $30,000. That's her $100,000 property basis minus the $70,000 debt the corporation assumed. It's a really foundational move for setting up your S-Corp right.
Okay, so the absolute core takeaway for you, our listener, seems to be, if you're setting up an S-Corp, or even just putting in significant appreciated property later on, property worth more than your basis, you absolutely have to understand and plan around that 80% control rule, especially if there's debt involved.
Couldn't say it better.
It's paramount for tax efficiency. Avoid those nasty surprise tax hits. It's all about that front-loading your tax planning. Save money from day one.
Precisely. And just to really solidify these calculations that everything else builds on, let's quickly touch on basis again. For the S corporation itself, its basis in any property it receives is generally the same as the shareholder's basis was in that property. Carryover basis.
Okay.
And for you, the shareholder, your initial stock basis. Think of it as your tax investment in the company. It's calculated as any cash you put in, plus the adjusted basis of property you contributed. But remember to subtract any liabilities the corporation took over related to that property, plus the fair market value of any services you might have contributed for stock. Though remember, services are usually taxable right away.
Right.
This initial basis. It's the foundation for everything later on. How much income you're taxed on, how many losses you can deduct. It all comes back to basis.
All right, so we've established S-Corp generally dodge that double taxation bullet. Huge advantage. But you hinted earlier, there are still some corporate level taxes they can get hit with. This feels really crucial for avoiding nasty surprises, doesn't it?
It really does.
Because you might think, great, I'm an S-Corp, no corporate tax, and then bam, a surprise bill from the IRS. Nobody wants that.
You're absolutely right to flag this. While the general rule holds S corporations typically don't pay tax at the corporate level, there are indeed 3 specific types of taxes that might apply. And here's the critical distinction for planning. They only apply if the S corporation was previously taxed as a C corporation.
Only if it converted from a C Corp.
Exactly. If you start your S corporation from scratch, elect S status from day one, you generally won't have to worry about these particular taxes. But if you are converting an existing C Corp, you need to pay very close attention here.
Okay, super important distinction. Let's break these 3 potential taxes down then. First up, you mentioned the LIFO recapture tax. What on earth is LIFO, and why is this tax a thing when converting?
Right. So LIFO stands for last in, first out. It's an inventory accounting method. It assumes the last inventory items you bought are the first ones you sell. During times when inventory costs are rising, using LIFO can result in showing a lower taxable income compared to other methods like FIFO.
FIFO being first in, first out.
Correct. FIFO assumes the first items you bought are the first ones sold. So if a C corporation using LIFO has been benefiting from this lower income recognition and then elects S status, the IRS essentially wants to recapture some of that deferred income.
They want their cut before it switches to flow through.
Pretty much. The rule is the corporation must include in its taxable income for its very last C corporation year the difference between what its inventory value would be using FIFO versus what it is using LIFO. It's basically accelerating the recognition of that income difference.
Okay, so it hits in the final C Corp year. How is the tax paid?
The tax resulting from this LIFO recapture amount is paid by the former C corporation. But there's a small relief. It can be paid in 4 equal annual installments. The first payment is due with that final C corporation return, and then the S corporation actually pays the remaining 3 installments over the next 3 years.
Okay, so a bit of a deferral on the payment, but the tax hit is real if you use LIFO as a C Corp. What's the next potential corporate tax? This one sounded like a biggie. The built-in gains tax, or big tax.
Yes, the big tax.
What's the basic idea, and more importantly, how can businesses try to avoid it? Because avoiding tax is definitely the theme here.
The built-in gains tax is definitely one of the most critical corporate-level taxes to understand if you're converting from C to S. It's a corporate-level tax that can get triggered if an S corporation sells or distributes certain assets that had already increased in value before the S election actually took effect.
So it taxes the appreciation that happened during the C Corp years.
Exactly. It applies when 2 conditions are met. First, a C corporation elects S status. Second, on the date of that S election, the total fair market value of all the corporation's assets is greater than their total adjusted tax basis. That difference, that pool of unrealized appreciation, is called the net unrealized built-in gain.
Look.
The whole point of this tax, from the IRS perspective, is to stop C corporations from just quickly converting to S status right before selling off a bunch of appreciated assets, just to avoid paying corporate-level tax on those gains that really built up during the C Corp phase.
Makes sense. So if you sell those specific assets later within a certain time frame.
Right. If those specific assets are sold or disposed of within a certain recognition period after the S election, the S corporation itself might have to pay tax on that built-in gain portion. The amount of gain you recognize in any single year is capped, though. It can't exceed the total net unrealized built-in gain you had at conversion, minus any built-in gains you already recognized and paid tax on in earlier S Corp years.
Okay, recognition period. How long is that? And are there ways out of this tax? Exemptions.
This is where the crucial tax planning comes in, because yes, there are significant exemptions, ways to avoid the big tax altogether. An S Corp is totally exemptive.
Okay, number one.
Number one, the simplest. It was never a C corporation. If you started as an S Corp from day one, no big tax worries from this source.
Best strategy if possible. What else?
Two, the sale or transfer of that specific asset happens after the recognition period ends. Currently, that recognition period is 5 years, starting from the first day the S election is effective.
5 years. Okay, so if you can hold on to that appreciated C Corp asset for more than 5 years after converting?
Then the big tax generally won't apply when you eventually sell it. That gives you a clear planning window. Hold for 5 years plus a day.
That's a huge planning point. What else?
3, the S corporation can prove that the appreciation on the asset actually happened after the S election took effect, not before. This obviously requires really good record keeping and maybe appraisals.
Okay, prove it happened later. Makes sense. 4.
4, the asset being sold or distributed was actually acquired by the corporation after the S election date. So it was never a C corporation asset with built-in gain in the first place.
Right. New assets are fine. And the last one.
5, the total net unrealized built-in gain that existed at the time of conversion has already been fully recognized and taxed in prior S Corp years. Basically, once you've paid the piper on all that pre-conversion appreciation, you're done with the big tax.
Okay, so if you convert from a C Corp, you've basically got that 5-year clock ticking on those old appreciated assets. Or the golden ticket is just start as an S Corp if you can. That seems like a massive strategic insight right there.
It really is. Starting fresh avoids this whole issue.
But if you do trigger it within that 5-year window, how's the tax actually calculated?
Okay, so the tax rate is 21%, which is the current flat C corporation tax rate. And you apply that rate to the lesser of 3 specific amounts for that year.
Lesser of 3.
1, the actual recognized built-in gain for the current year. That's the gain on the specific asset you sold that was actually built in back when you converted.
Okay.
2, the total net unrealized built-in gain calculated at the time of the S election, but reduced by any built-in gains you already recognized and paid tax on in previous years.
Yeah.
This acts as your overall lifetime cap.
Right, the total potential big tax pool.
Exactly.
Okay.
And 3, the taxable income of the S corporation as if it were still operating as a C corporation for that year. There are some adjustments here, like you don't get certain C Corp deductions, but it's basically a C Corp income calculation.
So you calculate all 3 and pay 21% on whichever number is the lowest.
That's the one. Let's run through an example. Example 3, Hyde Corp. They started as a C Corp, then elected S status effective January 1, year 3. At the start of year 3, they had inventory with a tax basis of $100,000, but its fair market value was $125,000. So that inventory alone had a $25,000 built-in gain. They also had some other assets, maybe some equipment with a built-in loss. When you netted everything together, their total net unrealized built-in gain across all assets at conversion was $15,000.
Okay, $15K total potential big tax gain.
Right. Now, in year 4, which is within that 5-year recognition period, Hyde sold all that inventory for $130,000. And let's say their taxable income for year 4, calculated as if they were a C Corp, was $100,000.
Okay, got the numbers. How's the tax work out?
So we find the lesser of these 3. Recognized built-in gain on the inventory sold. That's $25,000, the difference between the $125K value at conversion and the $100K basis. Total net unrealized built-in gain cap from conversion, that was $15,000. Taxable income if it were a C Corp, that was $100,000.
Okay, so the lowest of 25K, 15K, and 100K is $15,000.
Exactly. So the built-in gains tax for Hyde Corp in year 4 is $15,000 multiplied by the 21% Hyde Corp rate.
Which is $3,150.
$3,150. So you see, even though they recognized a $25K built-in gain on that specific sale, the tax was limited by that overall net unrealized big from the conversion date. Understanding these limits, and especially that 5-year window, is absolutely critical. Not planning for this can feel like you're still paying C Corp taxes even after you converted.
Definitely a trap to watch out for. Okay, what's the third and final potential corporate level tax? You mentioned one on passive investment income.
Right, the tax on passive investment income.
What triggers this, and what kind of income we're walking about? Because passive sounds pretty harmless, but I'm sensing another potential trap, probably again for converting C Corp.
You are sensing correctly. This is another 21% tax, and it's specifically imposed only if two distinct tests are met. And crucially, just like the big tax, this only applies if the S corporation has a history as a C corporation and it still has accumulated earnings and profits, or E&P, left over from those C Corp days.
Ah, the dreaded C Corp E&P again. So if you were always an S Corp, you're safe from this one too.
Safe from this one, too. If you were always an S Corp, or if you managed to distribute out all of your C Corp E&P after converting, this tax doesn't apply.
Okay, so what are the two tests if you do have C Corp E&P?
Test number 1 is just that. The S corporation must have accumulated C corporation E&P on its books from its prior C Corp existence.
Okay. And test two.
Test 2. Its passive investment income must exceed 25% of its total gross receipts for the year.
Okay, what counts as passive investment income here? Is it just like dividends and interest?
It typically includes things like royalties, dividends, interest, rents, and annuities. But importantly, for this specific tax calculation, gains from selling stocks or securities are not included in passive investment income.
Okay, so mostly income you get without actively working for it, excluding stock gains.
Pretty much. And this tax is definitely a warning sign. It can be quite punitive at 21%. But even more seriously, if an S corporation meets both these conditions, has C Corp E&P, and has passive income over 25% of gross receipts for 3 consecutive years.
3 years in a row, what happens then?
Then its S corporation status can be terminated entirely.
Wow. So this passive income thing, coupled with old C Corp E&P, can actually kill your S election.
It absolutely can. Which leads us right back to what we touched on earlier, and we'll discuss more later, the critical importance of strategically dealing with any C Corp E&P you might have. The IRS basically uses this tax and the termination threat to make sure companies that are mostly just holding investments and have old C Corp earnings don't completely avoid corporate level tax just by flipping the S switch.
Okay, let's shift focus now to the shareholder level, because that's really where, a lot of the direct individual tax benefits or maybe limitations hit home for business owners. Understanding your basis in your S Corp stock and maybe debt too feels absolutely critical. It sounds like your personal financial scorecard for the investment, right?
You've hit the nail on the head. Think of your basis as exactly that, your personal investment in the S corporation tracked for tax purposes.
Yeah.
And it's not static, it's constantly changing.
Okay, how does it work? How do you calculate it?
Well, your shareholder stock basis starts with whatever you initially put in. That's any cash, the adjusted basis of any property you contributed, maybe the fair market value of services if you got stock for that.
Right, the initial investment.
Then throughout the year, it goes up with any additional contributions you make, and critically, it goes up by all the income items that flow through to you from the S Corp. That includes ordinary business income, separately stated income like capital gains, even tax-exempt income the S Corp might receive.
Okay, income makes basis go up. What makes it go down?
It goes down when you receive distributions, either cash or property, from the S Corp. It also goes down for certain S Corp expenses that aren't deductible for tax purposes. And importantly, it goes down for any loss or deduction items that flow through to you, like ordinary business losses or separately stated losses.
It's like a running tally. Income up, distributions, and losses down.
Exactly. And the final number at the end of the year is your ending stock basis. Now, there's a really key difference here between S Corp and partnerships, something that often trips people up if they're used to partnership taxes.
Oh, yeah?
What's that? S corporation shareholders do not get to include any corporate level debt, like a bank loan the corporation took out in their personal stock basis.
Really? Partnerships do that, right?
Partnerships generally do under different rules. But for S Corp, nope. Your basis doesn't increase just because the company borrowed money from a third party.
Okay. That seems like a big difference.
It is. However, there's a partial workaround. If you, the shareholder, personally make a direct loan to the S corporation.
Like shareholder lends money to their own company.
Exactly. Then you do get a separate debt basis specifically for that loan. This debt basis acts like an extra pool of basis alongside your stock basis that can allow you to deduct more losses if your stock basis runs out.
Ah, okay. So direct shareholder loans create debt basis. Does that basis change?
Yes, it gets reduced when the S corporation repays part or all of that loan back to you. And a critical rule for both. Neither your stock basis nor your debt basis can ever be reduced below zero. You can't have negative basis.
Okay. Zero is the floor.
Zero is the floor. And really understanding both your stock and debt basis is fundamental because it directly controls how much S corporation loss you can actually deduct. And it also impacts how distributions are taxed when you take money out.
This whole basis concept, stock basis and debt basis, really feels like the absolute bedrock for figuring out how much loss you can actually write off. Can you maybe walk us through a quick example? Show us how these bases go up and down during a year.
Sure. Let's take example 4. We'll call him Don. Don is a 10% shareholder in Cowan Corp, an S corporation.
Okay, 10% owner.
At the end of year 1, his stock basis was $60,000. Now, in year 2, Cowan Corp had $200,000 of ordinary business income, just regular profits. It also had $5,000 in separately stated interest income. And it made $15,000 in charitable contributions, which is also separately stated.
Okay, income, interest, donation. What?
During year 2, Don, the shareholder, received $25,000 in cash distributions from the company. And, to add that debt basis wrinkle, Don had also personally loaned Cowan Corp $50,000 at the very beginning of year 2. The corporation then repaid $10,000 of that loan back to Don during the year.
Okay, lots of moving parts. How does this basis track? Let's start with stock basis.
Right. Let's track Don's stock basis for year 2. He starts with $60,000 beginning basis. Add his 10% share of the $200K ordinary income, that's plus $20,000. Add his 10% share of the $5K interest income, that's plus $500. Add his 10% share of the $5K interest income. Now subtract the $25,000 cash distribution he received. And finally, subtract his 10% share of the $15K charitable contribution. That's minus $54,000.
Okay, so 60K plus 20K plus $500, 25K,
Yeah.
$1, 5K, so carry the one. Looks like $54,000.
Exactly. Don's ending year 2 stock basis is $54,000.
Okay, and what about his debt basis from that loan?
That's simpler for this year. He started year 2 by making a $50,000 loan, so his initial debt basis was $50,000. Then subtract the $10,000 repayment he received from the corporation. So his ending year 2 debt basis is $40,000.
Got it. So he has 54K in stock basis and 40K in debt basis at the end of year 2.
Correct. And that constant tracking, that ebb and flow as you called it, is what lets you accurately figure out your tax implications each year, especially when we get to the big one, deducting losses.
Okay, let's talk about that big one then. Passing through losses. When the S-Corp loses money, the owners obviously want to deduct that loss on their personal returns, right? Offset other income.
That's usually the goal, yes.
But I hear there are several hurdles you have to clear to actually deduct those S-Corp losses. These sound absolutely vital for maximizing your write-offs, yeah? Because a loss on the company books doesn't automatically mean a deduction for you.
That's exactly right. Think of it like a series of gates or checkpoints the loss has to pass through before it lands on your individual Form 1040. There are 4 specific hurdles, and they have to be cleared in order. If the loss gets stopped at any hurdle, it's suspended.
4 hurdles. Okay, what are they?
In order, they are 1, the tax basis limitation. 2, the at-risk limitation. 3, the passive activity loss, or PAL, limitation. 4, and finally, the excess business loss limitation. Now, our source material really focuses on the first 2 hurdles because they're directly tied to your investment in the S-Corp itself, and they get applied first, right at the entity pass-through level.
Okay, so let's focus on those first 2 then. Tax basis and at risk. How does the tax basis limitation work?
The tax basis limitation is pretty straightforward conceptually. It says you can only deduct S corporation losses up to the amount of your total tax basis. That means you add together your stock basis and the basis in any direct loans you've personally made to the S corporation.
So stock basis plus debt basis equals your loss limit.
That's your initial ceiling, yes. If your share of the S corp's loss for the year is more than your total combined basis, the excess loss is suspended. You can't deduct it in the current year.
Suspended. Is it gone forever?
Not necessarily, and this is a key planning point. It's carried forward indefinitely. You can potentially deduct it in future years if and when your basis is reinstated.
How does basis get reinstated?
By having future S-Corp income or gains flow through to you, or by making additional capital contributions, or even making new direct loans to the corporation, anything that increases your basis can potentially free up those suspended losses.
Ah, okay. So future profits can unlock past losses.
Exactly. And one crucial detail for planning. When your basis increases in a future year after it's been reduced by losses, the increase first goes to restore any debt basis that was used up by losses, bringing it back up. Only after debt basis is fully restored does the increase start rebuilding your stock basis.
Okay, debt basis gets restored first, then stock basis. Good to know. What's the catch with suspended losses?
The big catch, a major warning for tax planning, is if you sell or otherwise dispose of your S corporation stock before you have enough basis restored to use up those suspended losses, those losses are permanently lost, gone forever.
Ouch. So you really need to manage your basis and the timing of realizing losses or selling stock.
Actively managing basis is critical if you have suspended losses. Now, the second hurdle is the at-risk limitation.
Okay, how is this different from the tax basis limit?
It's similar, but it focuses specifically on your personal risk of financial loss in the business. Usually, your at-risk amount is the same as your combined stock and debt basis, but it can be lower.
How could it be lower?
The most common way is if you use non-recourse financing to fund your investment or your loan to the S-Corp. A non-recourse loan is one where you're not personally liable. The lender can only go after the specific property securing the loan, not your other personal assets.
Okay. So if you used a non-recourse loan to buy stock or lend money to the S-Corp.
That amount might be included in your tax basis, but it wouldn't be included in your at-risk basis because you don't have personal economic skin in the game for that specific amount beyond the collateral.
Gotcha. So the at-risk rules can provide a lower ceiling for loss deductions than the basis rules sometimes.
Correct. And just like with the basis limitation, any loss that gets stopped by the at-risk limitation is suspended and carried forward indefinitely until your at-risk basis increases. There's a slight silver lining here compared to basis suspension, though. If you have losses suspended due to the at-risk rules when you eventually sell your stock, those specific suspended losses can be used to offset any gain you have from selling the stock.
Okay, that's a bit better than the basis suspended losses, which just disappear if you sell. This whole suspended loss concept feels like such a critical planning area. You can't just assume you can deduct every loss. But the fact they can be carried forward is good news. Can you show us how that works in practice? Like how future income really can unlock those prior losses? That feels like a powerful, real-world tax-saving move.
It absolutely is. It shows why tracking basis and understanding these rules pays off. Let's use example 5, Anna. At the end of year 1, Anna's stock basis in her S-Corp was $30,000. She also had a $10,000 debt basis from a personal loan she'd made directly to the company.
Okay, so $40,000 total basis, $30K stock plus $10 debt.
Right. Now, in year 2, the S-Corp had a rough year. Anna's share of the ordinary business loss was a hefty $75,000.
$75K loss, but only $40K basis.
Exactly. So applying the tax basis limitation, Anna can only deduct $40,000 of that loss in year 2. That's the sum of her stock and debt basis. That deduction wipes out both her stock basis down to $0 and her debt basis down to $0.
Okay, so she got a $40K deduction, but what about the rest of the loss? The other $35,000?
The remaining $35,000, $75K total loss, $40K deducted, is suspended. It's put on hold, carried forward, waiting for her basis to come back.
Okay, loss suspended. Now what happens next year? Let's say things turn around.
Perfect scenario. In year 3, the S Corporation has a great year. It generates ordinary business income, and Anna's share is $50,000.
Okay, $50 income, does that just get taxed?
Yes, that $50,000 income flows through and is taxable income on Anna's personal return for year 3. But it also does something crucial for her basis and those suspended losses. Remember how basis reinstatement works?
Debt basis gets restored first, then stock basis.
Exactly. So that $50,000 of income first goes to reinstate her debt basis, which was wiped out in year 2. It takes $10,000 of the income to bring her debt basis back up to its original $10,000.
Okay, debt basis back to $10K. What about the remaining $40K of income?
The remaining $40,000 of income then increases her stock basis, bringing it up from $0 to $40,000.
Okay, so now she has basis again. $10K gets debt, $40K stock. What about that $35K suspended loss from year 2?
Now we get the aha moment, the payoff. Because her basis has been reinstated by the year 3 income, that suspended $35,000 loss from year 2 can now be flowed through and deducted in year 3. It offsets part of that $50,000 income she just recognized.
Awesome. So the old loss reduces the tax hit from the new income.
Precisely. After applying that $35,000 suspended loss deduction, her stock basis is then reduced by that amount. So her ending stock basis for year 3 is $5,000, $40,000 minus the $35,000 loss deduction.
Okay, so end of year 3, she has 5K stock basis and 10K debt basis. Total 15 tackling basis.
Correct. This example perfectly shows that recovery mechanism. Future income or additional investments don't just get taxed, they can unlock prior deductions, making basis management a critical, ongoing strategy that directly impacts your tax bill year after year.
That's incredibly powerful. It really shows why just looking at 1 year in isolation isn't enough. You got to track this stuff.
Yeah.
Okay, what about allocating income and losses if ownership changes mid-year? Is it just based on who owns the stock at year-end?
No, it's more precise than that. It's generally done on a per share, per day basis, very similar to how partnerships allocate.
Per share, per day. How does that work?
It means if someone sells their shares partway through the year, the income or loss for the entire year is allocated based on exactly how many shares each person own on each specific day of the year. It ensures fairness.
Okay, can you give us a quick example of that?
Sure. Let's use example 6, Duffy Corp. Duffy is an S-corp owned equally by 3 shareholders, Rick, Tim, and Peter, 1/3 each. On February 1st of year 5, Peter sells his entire 1/3 interest to a new shareholder, George.
Okay, Peter's out, George is in on Feb 1st.
Right. For the whole of year 5, Duffy Corp had $120,000 of ordinary business income. Now, Rick and Tim own their 1/3 shares for the full 365 days, so their allocation is simple. $120,000 total income times 1/3 interest equals $40,000 each.
Okay, 40K each for Rick and Tim. What about Peter and George?
Peter only owned his 1/3 interest for the first 31 days of the year, January 1st through January 31st. So his share of the potential $40,000 income, his 1/3 slice, is prorated for those 31 days. The calculation is 31 days, 365 days, $40,000.
Okay, 31 divided by 365 times 40K. Sounds like a small number.
Comes out to $3,207 for Peter.
Got it. And George?
George bought Peter's shares and owned them for the remaining 334 days of the year, Feb 1st to December 31st. So his allocation is 334 days, 365 days, $40,000.
Okay, 334 divided by 365 times 40K. That's going to be most of the 40K.
Right, it comes out to $36,603 for George.
Wow.
See how that per share per day method accurately assigns the income to the person who actually owned the stock during the period it was theoretically earned? Prevents someone being taxed on income earned before they were even an owner?
That makes perfect sense. Precision matters. Now, besides just ordinary business income or loss, you mentioned other things flow through separately.
Yes, quite a few things. These are called separately stated items. They flow through individually to the shareholder's K-1 because they might be treated differently on your personal tax return. They keep their original character.
Like what kind of items?
Things like rental real estate income or loss, interest income, dividend income, royalties, net short-term capital gains or losses, net long-term capital gains or losses, Section 1231 gains or losses, that's from selling certain business property, charitable contributions made by the S-corp, and the Section 179 expense deduction for asset purchases.
So all those keep their special tax characteristics when they hit your personal return.
Exactly. They're not just lumped into one big ordinary income number. This allows for things like preferential capital gains rates, specific deduction limitations, etc., to be applied correctly at the individual level.
Gotcha. Any other big shareholder benefits we should mention?
One more really significant one, especially in recent years, is the Section 199A qualified business income deduction, often called the QBI deduction.
Oh, yeah, I've heard of that. How does it work for S-corp?
It's a potentially powerful deduction taken directly on your individual return. It's below the line. It can allow you to deduct up to 20% of the qualified business income that flows through to you from your S corporation.
20%? That sounds amazing. Are there catches?
There are definitely catches. It's subject to various limitations based on your overall taxable income, whether your business is considered a specified service trade or business, and potentially based on W-2 wages paid by the S-corp and the basis of its assets. But if you qualify, it's a direct reduction to your taxable income, not just a business expense. It can significantly lower your overall tax bill, making S-corp status even more attractive for many.
All right, we've covered getting money in, managing losses, how income flows through. Now let's get to the part many business owners are really interested in, getting money out. How are distributions from an S corporation taxed? And what are the critical things you need to know for tax planning here? Because this is where you want to see the reward for setting up the S corp, right?
Absolutely. This is where the rubber meets the road for shareholders wanting access to the company's profits. And it's an area where you can find both significant tax savings and some really nasty, unexpected traps if you're not careful.
Okay, lay out the general rule first. How are distributions usually treated?
The general rule, which is a cornerstone advantage of S corporations, is that distributions to shareholders are typically not taxable.
Not taxable. Why not?
Because theoretically, that income has already been taxed when it flowed through to you on your Schedule K-1 each year. Remember, you pay individual income tax on your share of the S Corp's income, whether you received it in cash or not.
Ah, right. You already paid tax on it when the company earned it.
Exactly. So when the cash is actually distributed later, it's generally just considered a return of that already taxed income, or maybe a return of your original capital investment. Both are typically non-taxable events.
Okay, that sounds great. Simple enough. But I sense a but coming.
You sense correctly. There is a big BUT. And this is where things get tricky and where many people get caught off guard. Distributions can be taxable under certain circumstances. Specifically, if the S corporation has prior C corporation earnings and profits that E&P we keep talking about left over from before it made the S election.
There it is again, that C Corp E&P haunting us.
It really is the ghost in the machine for converted S corp. If your S corp was always an S corp, you generally don't worry about this. But if it converted, you absolutely need to know if it still has C corp E&P on its books, because it dramatically changes how distributions are taxed.
Okay, so let's break this down. How do the distribution rules work if the S Corp has NOC Corp E&P? The simpler scenario first.
Right. If there's no C corp E&P, distributions are taxed according to a specific tiered order. Tier 1. The distribution is first considered to come out of the S corporation's accumulated adjustments account, or AAA.
What's that?
Think of AAA as the S corp's piggy bank for all the earnings that have already been taxed at the shareholder level since it became an S corp but haven't yet been distributed. It's previously taxed money. Distributions from AAA are non-taxable and they reduce your stock basis.
Okay, Tier 1. AAA, non-taxable, reduces basis. What if the distribution is bigger than the AAA balance?
Then we move to Tier 2. The distribution is considered to come from the Other Adjustments account, or OAA. OAA tracks things like tax-exempt income received by the S corp, like tax-free municipal bond interest or life insurance proceeds. These items increase your basis when received by the S corp but weren't taxable, so distributing them is also non-taxable and reduces your stock basis.
Okay, Tier 2. OAA, non-taxable, reduces basis. What if the distribution still hasn't been fully covered?
Tier 3. If there's still distribution amount left after exhausting both AAA and OAA, it's treated as a return of your remaining stock basis. This is just getting your original investment back, so it's also non-taxable, and it further reduces your stock basis down to zero, potentially.
Tier 3. Return of basis, non-taxable, reduces basis. So up to this point, it's all tax-free. When does it become taxable?
Only in Tier 4. Any distribution amount that exceeds your total stock basis, after reducing it for AAA and OAA distributions, is taxed as a capital gain. Usually long-term capital gain, assuming you've held your stock for more than a year.
Right.
This is where you're essentially pulling out more than you ever put in or were taxed on as income.
Okay, that makes sense. Tax-free up to basis, then capital gain. Can you give an example of that?
Sure. Let's use Feline Corporation. Carlin is a shareholder. She receives a $22,000 distribution. Right before the distribution, her stock basis was $18,000. Feline Corp had 0 AAA, 0 OAA, and no C Corp E&P.
Great. 22K distribution, 18K basis, no AAA, OAA, and P.
So following the tiers, there's no AAA or OAA. We go straight to Tier 3, return of basis. The first $18,000 of the $22,000 distribution is treated as a non-taxable return of capital. This reduces her stock basis from $18,000 down to 0.
Okay, 18K tax-free. But there's still $4,000 of the distribution left. 22K, 18K. What happens to that?
That remaining $4,000 is now in excess of her stock basis, which is 0. So that $4,000 falls into Tier 4 and is taxed to Carlin as a long-term capital gain.
Got it. Basis wiped out. Excess is capital gain. Pretty clear. Now, the scary part. How do these rules change if the S Corp does have that dreaded C Corporation E&P?
This is where the order changes significantly, and it's absolutely critical to understand. If there is C Corp E&P, the distribution tiers look like this. Tier 1 still comes from AAA first, non-taxable, reduces stock basis, same as before.
Okay, AAA first is consistent. What's next? This is where the twist comes.
Here's the twist. Tier 2 is not OAA or basis return. Tier 2 is now distributions considered to come from C Corporation E&T.
Uh-oh. And how is that taxed?
This portion of the distribution is taxed as a dividend to the shareholder, just like a dividend from a regular C corporation.
Sure.
And critically, it does not reduce your stock basis.
Taxable dividend and no basis reduction. That's a double whammy.
It really is. This is the unexpected taxable surprise that bites many shareholders of converted S-Corp. You thought you were getting a tax-free distribution from AAA, but oops, you hit the E&P layer first, after AAA.
Okay, so after AAA is exhausted, any C Corp E&P comes out next as a taxable dividend. What happens after the E&P is all distributed?
Then we go back to the sequence we saw before. Tier 3, distributions come from OAA, non-taxable, reduces stock basis. Tier 4, distributions are a return of remaining stock basis, non-taxable, reduces stock basis. Tier 5, anything left over in excess of basis is taxed as long-term capital gain.
Wow. That C Corp E&P layer inserted right after AAA completely changes the game. Can you illustrate that?
Definitely. Let's look at Newell Corporation. It used to be a C Corp and had $20,000 in accumulated C Corp E&P when it switched to S status. In year 9, let's say its AAA balance was $90,000, maybe $40K carried over, plus $50K earned in year 9. Now, in year 9, it makes a $120,000 distribution to its shareholders.
Okay, $120K distribution, $90K AAA, $20K C Corp E&P. How does it play out?
Following the tiers for core with E&P, Tier 1, the first $90,000 of the $120,000 distribution comes from AAA. That's not taxable, and it reduces the shareholder stock basis and wipes out the AAA balance.
Okay, $90 TA tax-free. Distribution remaining is $30K, $120K, $90. What's next?
Tier 2, the next $20,000 of the distribution comes from the C Corporation E&P. This $20,000 is a taxable dividend to the shareholders. It does not reduce their stock basis, and it wipes out the C Corp E&P balance.
Taxable dividend. Ouch. Okay, so that accounts for $90K plus $20K equals $110 to distribution. There's still $10 left. $120K, $110. What about that?
Now we move past E&P. Tier 3. We check OAA. Let's assume OAA is 0. Tier 4. That remaining $10,000 is treated as a non-taxable return of stock basis, reducing the shareholders' basis by $10. Tier 5. If that $10 had exceeded remaining basis, the excess would be capital gain.
So out of 120K distribution, 90K was tax-free from AAA, 20K was a taxable dividend from E&P, and $10 was a tax-free return of basis. Man, knowing that E&P balance is absolutely critical.
Essential. It's a prime target for strategic tax planning to avoid that dividend surprise.
Speaking of strategy, this E&P seems like a real pain. You mentioned earlier there's a way to maybe deal with it proactively. Something about an election, the election to bypass AAA. That sounds intriguing, like you can choose to get rid of the E&P first.
That's exactly what it is. It's a very powerful, though often overlooked, strategic tool available to S corporations that do have prior C Corp E&P. With the consent of all affected shareholders, the S corporation can formally elect to treat distributions made during a specific year as coming first from the C corporation accumulated E&P before tapping into the AAA.
So you flip the first two tiers. You choose to take the E&P hit first. Why would you want to do that? Isn't E&P the taxable part?
It is taxable as a dividend, yes. But there are two very important strategic reasons why an S corporation might intentionally make this election.
Okay, reason one.
Reason 1, to eliminate the C corporation E&P altogether, specifically to avoid potential S status termination. Remember how we said having C Corp E&P and too much passive income for 3 years can kill your S election?
Right, the passive income termination rule.
By electing to bypass AAA and distribute all the E&P first, you can completely drain that E&P account. Once the E&P is gone, the passive income termination rule no longer applies to you. It's a powerful preventative measure to protect your S status, even if it means recognizing some dividend income now. Sometimes taking a small tax hit now is better than losing S status later.
Ah, okay. Get rid of the poison E&P to save the S election. That makes a lot of sense. What is the second reason?
Reason 2, strategic timing. Maybe it's a year where the shareholders happen to be in a relatively low individual income tax bracket. Perhaps they have large deductions or losses from other sources on their personal returns. In such a year, it might actually be advantageous for them to choose to receive that taxable dividend income from the E&P at that lower rate, rather than having it potentially forced on them in a future year when their tax rates might be much higher.
So you use the election to control when you recognize the taxable dividend, aiming for a low tax year.
Exactly. It gives you control over the timing and character of the distribution, turning a potential future problem into a managed event.
That is a really clever strategic move. Can you show us how that bypass election works with numbers?
Sure. Let's use example 7, Martin Corp. At the end of year 2, Martin Corp, an S Corp, has $100,000 in its AAA account and $20,000 in prior C Corporation EMP. They decide to make a $50,000 cash distribution to their sole shareholder, Terry. And critically, they elect to bypass AAA for this year 2 distribution.
Okay, $100K AAA, $20K ENP, $50 distribution, and they make the election. What happens?
Because they made the election, the normal distribution order is reversed for EMP and AAA. So the first $20,000 of that $50,000 distribution is deemed to come straight from the C Corp EMP.
Okay, and that $20K is
That $20,000 is taxable dividend income to Terry. And remember, it does not reduce his stock basis. It also completely empties the C Corp EMP account, achieving that goal.
right. So $20K taxable dividend, EMP gone. What about the remaining $30K of the distribution? $50K total, $20K from EMP.
The remaining $30,000 then comes from the next available bucket according to the election, which is the S Corp AAA. This $30,000 distribution is non-taxable, return of previously taxed income, and it does reduce Terry's stock basis. It also reduces the AAA balance from $100A down to $70.
Interesting. So if they hadn't made the election, the whole $50 would have come from AAA, been tax-free, reduced basis, and left the $20K EMP still sitting there, potentially causing problems later.
Precisely. The election allowed them to strategically eliminate the EMP, even though it meant recognizing $20 of dividend income in year 2. It clearly demonstrates the control this election provides over the tax outcome.
That's a fantastic tool to have in the S-Corp toolkit. Now, one more distribution question. What if the S-Corp distributes actual property, like, say, a piece of equipment or some land, instead of just cash? Are there hidden tax implications there? Does it work the same way?
Property distributions. Yes, there are definitely critical implications here, and they are not the same as cash distributions, especially for the S Corporation itself.
Okay, how does it work for the S-Corp when it distributes property?
When an S Corp makes a non-liquidating distribution of property, the amount of the distribution to the shareholder is the property's fair market value, FMV, on the date of distribution. Now, for the S Corporation's tax treatment, if the property has appreciated, meaning its FMV is higher than the corporation's adjusted tax basis in it, the S Corporation must recognize gain.
The S-Corp recognizes gain, even though it's just distributing it.
Yes. It's treated as if the S Corporation sold the property to the shareholder for its fair market value right before distributing it. That recognized gain then flows through to all the shareholders on their K-1s, increasing their stock basis, just like any other operating income.
Wow, okay. Gain is recognized on appreciated property. What if the property has gone down in value? Depreciated property, FMV, is less than basis.
And here is the crucial trap, a major tax planning blunder to avoid. An S Corporation does not recognize a loss on the distribution of depreciated property to its shareholders in a non-liquidating distribution.
No loss recognition. So if the property is worth less than the company's basis, that loss just disappears.
It's disallowed at the corporate level. It cannot be deducted by the corporation, nor does it flow through to the shareholders. That potential tax deduction for the loss is simply vaporized.
Ouch. That seems really important. Gain recognized, loss denied.
Huge point. And regardless of whether gain was recognized or a loss was disallowed, the S Corporation's AAA account, and potentially EMP, following the ordering rules, is reduced by the full fair market value of the property distributed.
Okay, so that's the S-Corp side. What about the shareholder who receives the property?
For the shareholder, first you'll recognize your share of any gain that the S Corporation recognized on the distribution, if the property was appreciated, and that increases your stock basis. Then, the distribution itself reduces your stock basis by the fair market value of the property you received. Finally, your tax basis in the property you just received is its fair market value on the date you received it.
Okay, that seems complex. Can we see an example? Especially highlighting that disallowed loss trap.
Absolutely. Let's use example 8, Mills Corp. Zoe and Brody are equal, 50% shareholders in Mills Corp and S Corp. Mills had plenty of AAA, $400K, and both Zoe and Brody had plenty of stock basis, $200 each. In year 4, Mills decides to distribute some assets.
Okay.
It distributes appreciated property to Zoe. This property had a basis to Mills Corp of $30,000, but a fair market value of $150,000. Simultaneously, it distributes depreciated property to Brody. This property had a basis to Mills Corp of $180,000, but a fair market value of only $150,000.
Okay, appreciated to Zoe, depreciated to Brody, same FMV, different basis. How does this shake out?
Let's look at the S Corp first. On the appreciated property to Zoe, Mills Corp recognized a gain of $120,000, 150K F&B 30K basis. This $120,000 gain flowed through equally to Zoe and Brody, increasing each of their stock bases by $60,000. On the depreciated property to Brody, Mills Corp had a built-in loss of $30,000, 150K F&B 180K basis. However, Mills Corp was not allowed to recognize this $30,000 loss. That tax deduction opportunity vanished.
Poof, gone. That $30K loss deduction is just lost.
Lost to everyone. Now, for the distributions themselves, AAA was reduced by the total FMV distributed. 150K plus 150K equals 300K. And each shareholder's stock basis, after being increased by their $60K share of the game, was reduced by the 150K FMV of the property they received.
This really highlights that loss issue. It seems like, from a pure tax planning standpoint, you should almost never have the S Corp distribute depreciated property directly.
That's generally the advice, yes. Because the corporation loses the ability to recognize that valuable loss. If you have depreciated assets you want to get out of the S Corp and into the shareholders' hands, it's often much better tax-wise to have the S Corporation sell those assets first to an unrelated third party.
Why?
Because the S Corporation can then recognize the loss on the sale. That loss flows through to the shareholders, giving them a tax deduction, subject to basis limits, of course. Then the S Corporation can distribute the cash proceeds from the sale to the shareholders, following the normal cash distribution rules, likely tax-free from AAA air basis.
Ah, sell first, recognize the loss, then distribute the cash. That's a much smarter play than distributing the lost property directly.
It's a subtle but really significant difference that can save you real tax dollars. Avoid distributing lost property if you can.
Wow, that property distribution rule is a critical one. Could easily cost you money if you're not aware. Okay, so with all these amazing tax benefits and these strategic planning opportunities S Corp offer, losing that S status would feel like a real punch to the gut. What are the main ways that can happen? What are the key terminating events that shareholders need to be super aware of so they don't accidentally blow it?
You're absolutely right. Protecting that S election is crucial. And yeah, it's sometimes easier to lose it than people realize. There are really three primary ways an S election can terminate.
Okay, number one.
First, a voluntary revocation. This is straightforward. It happens if shareholders holding more than 50% of the total stock that includes both voting and non-voting shares agree to end the S election. They file a statement with the IRS, and they can even specify the date they want the termination to be effective.
Okay, the owners can just choose to end it. Makes sense. What's number two?
Second, the corporation fails to meet the S corporation qualification requirements at any point after the election is made. This is where a lot of accidental terminations happen.
Like what kind of failures?
For instance, maybe the number of shareholders grows beyond the limit, which is currently 100. Or the corporation might acquire an ineligible type of shareholder, like a partnership, another corporation usually, or certain types of trusts that aren't permitted. Or maybe the S Corp inadvertently creates a second class of stock, meaning shares that have different rights to distributions or liquidation proceeds than the other shares. That's a strict no-no for S Corp. They can generally only have one class of stock outstanding, though differences in voting rights are usually okay. Any breach of those fundamental eligibility rules can terminate the S election immediately.
Yikes. So you have to constantly monitor those basic requirements.
Yeah. What's the third way to lose S status? The third way ties back to our old friend C Corp E&P and passive income. It's termination due to excess passive investment income. This happens if more than 25% of the S corporation's gross receipts come from passive sources, like rents, royalties, dividends, interest, remember, not stock gains, for 3 consecutive tax years.
3 years in a row of too much passive income.
But, and this is the critical qualifier again, this termination rule only applies if the corporation also has accumulated C corporation earnings and profits from its prior C Corp days still on the books.
Ah, so if you have no C Corp E&P, you can have tons of passive income and it won't kill your S status.
Yeah.
Though you might pay that passive income tax we discussed if E&P does exist.
Exactly right. If the S Corp was never a C Corp, or if it successfully got rid of all its C Corp E&P, maybe using that bypass AAA election, then having too much passive income won't terminate its S status. It just underscores again how vital managing that C Corp E&P is for the long-term health of your S election if you convert it.
Okay, so it's not just about getting the election right initially, but actively maintaining it. What happens when status actually is terminated? Does the S Corp just instantly become a C Corp that day? And how do they handle the taxes for the year it happens midstream?
It's rarely a clean overnight switch, and handling the tax year can be complicated. The effective date of the termination depends on why it terminated.
Okay.
For a voluntary revocation, the shareholders can specify a future date. If they don't, and they file the revocation by March 15th of the year, it's usually effective back to January 1st of that same year. If they file after March 15th without specifying a date, it's usually effective January 1st of the next year.
Okay. What about failing the qualifications, like getting an ineligible shareholder?
If the corporation fails to meet an eligibility requirement, the S status terminates immediately on the date the failure occurs. Not retroactive, not next year the day it happens.
Instant termination. Ouch. And for the path of income rule?
For excess passive income, remember it takes 3 consecutive years. If that happens, the status is terminated effective at the beginning of the 4th year.
Okay, so the effective date varies. Now, what about taxes in that termination year, especially if it happens mid-year?
Termination, particularly a mid-year one, like from failing a qualification or a specific revocation date, usually results in the corporation having 2 short tax years within that 1 calendar year. There's an S short year covering the period it was an S corp, and a C short year for the period after termination when it's taxed as a C corp.
2 short years in one. How do they split the income and deductions between the S part and the C part?
There are generally 2 methods allowed. The default method is to allocate the income or loss for the entire calendar year between the S short year and the C short year based on the relative number of days in each short period. It's a pro rata daily allocation.
Okay, just split the whole year's results based on days. What's the other option?
The other option, which the corporation can elect if certain conditions are met, like getting shareholder consent, is to perform a closing of the books. This means they specifically determine the income, deductions, credits, etc. that actually occurred during the S short year and report those, and then do the same separately for the C short year. It's based on when the items actually happened, not just a daily average.
Okay. Closing the book sounds more accurate, but maybe more work. Can you show how those 2 methods might give different results?
Definitely. Let's use example 9. AV Corp. Rave Corp is a calendar year S corporation. Let's say its S status was involuntarily terminated effective April 1st, year 3, because maybe it got an ineligible shareholder that day.
Okay, terminated April 1st. So it's an S corp for Jan, Feb, Mar, Phase 4.
Right. 90 days in the S short year, Jan 1, Mar 31. And that leaves 275 days in the C short year, April 1 to Cynthia 1. Now, let's say for the entire 365-day year, REV Corp had total net income of $100,000. But if we actually look closer, maybe it had a $20,000 loss during the first 3 months, the S period, and then made $120,000 in income during the last 9 months, the C period. That still nets to $100 for the year.
Okay, $100 K total, but really a loss than a bigger gain. How do the 2 allocation methods handle this?
Method 1, pro rata daily allocation. You take the $100,000 total income for the year. S short year gets $100,000, 90 days, 365 days, $24,658 of income. This flows through to shareholders. C short year gets $100,000, 275 days, 365 days, $75,342 of income. This is taxed at the C Corp level.
So the S Corp shareholders get taxed on income even though a company actually lost money during the S period.
Under the daily allocation method, yes, in this specific scenario. Now, method 2, closing of the books. If RAV elects this, they look at the actual results for each period. S short year reports the actual $20,000 loss. This loss flows through to shareholders, deductible subject to basis, etc. C short year reports the actual $120,000 income. This income is taxed at the C Corp level.
Wow. That's a huge difference, a 20K loss pass-through versus 25K income pass-through for the shareholder.
Exactly. This choice between daily allocation and closing the books can be a very significant planning tool in the year of termination. Depending on the actual pattern of income and loss, one method might be much more favorable than the other for the shareholders or the corporation.
That flexibility is really valuable.
Yeah.
Now, one last termination question. If you do lose your S status, can you just turn around and file Form 2553 again to get it back next year? Or are you stuck as a C Corp for a while?
Unfortunately, you're generally stuck for a while. Once an S election is terminated, either voluntarily or involuntarily, the corporation or any successor corporation usually has to wait until the beginning of the 5th year, after the year in which the termination was effective, before it can re-elect S corporation status.
5 years. That's a long time to be back in C Corp land, potentially facing double taxation again.
It is. There can be exceptions if the termination was inadvertent and fixed quickly, or if the IRS consents to an earlier reelection, but the general rule is a 5-year waiting period.
Hmm.
It really emphasizes how important it is to safeguard that S election once you have it. The IRS doesn't want companies flipping back and forth easily.
Okay, 5 years is a long penalty box. Definitely want to avoid termination. So let's move to the final stage for many businesses, liquidation, the end of the road. How does winding down and liquidating an S corporation work from a tax perspective? How does it impact the business itself and maybe more importantly, the shareholders who are getting the final assets out?
Right, the final act. When an S corporation liquidates, the tax treatment is generally handled very similarly to how a C corporation liquidation is treated. This often surprises people because they think S corp avoid double tax, but liquidation often involves tax at both the corporate level and the shareholder level.
2 levels of tax even on S corp liquidation. How does that work?
Okay, let's break it down. First, the consequences to the S corporation itself. When the S corp distributes its property out to the shareholders as part of a complete liquidation, the corporation generally must recognize gain or loss as if it had sold that property to the shareholders for its fair market value, FMV, on the date of distribution.
So just like with the non-liquidating property distributions we talked about, gain recognized, loss may be recognized.
Gain is definitely recognized on appreciated property. Loss recognition is a bit trickier in liquidation. While losses can sometimes be recognized by the corporation on distributing depreciated property in liquidation, unlike non-liquidating distributions, there are specific restrictions. Importantly, losses are generally not recognized by the corporation if the distribution is made to a related party, like a shareholder who owns more than 50% of the stock, or their family members if the distributed property wasn't acquired by the S corp in the last 5 years, or if it's not distributed pro rata. The rules get complex, but the key takeaway is that gain is usually recognized, loss recognition is less certain, especially with related parties.
Okay, so the corporation potentially recognizes gain or loss. What happens to that gain or loss?
That gain or loss recognized by the S corporation on the deemed sale of its assets during liquidation flows through to the shareholders' K1s, just like any other S corp income or loss for that final year. And crucially, this flow-through adjusts the shareholders' stock basis before they calculate their own personal gain or loss on the liquidation.
So the corporate level gain loss hits basis first. Okay, then what happens at the shareholder level?
For the shareholders, the liquidating distributions they receive, cash plus the FMV of any property minus any corporate liabilities they personally assume, are treated as payment received in exchange for their stock. It's like they sold their stock back to the company for the value of the assets they received.
Okay, treated like a stock sale. So how do they calculate their gain or loss?
Each shareholder calculates their gain or loss by taking the total amount they realized from the liquidation, cash plus FMV of property liabilities assumed, and subtracting their final adjusted stock basis, the basis after accounting for the flow-through gain or loss from the corporation's deemed asset sales in that final year.
Got it. Realized amount minus final adjusted basis equals shareholder gain or loss. And what kind of gain or loss is it? Ordinary capital.
It's typically capital gain or loss for the shareholder, assuming the stock was a capital asset in their hands, which it usually is for investors. Whether it's short-term or long-term depends on how long they held the S corporation's stock. And one last point. The shareholder's tax basis and any property they receive in the liquidation is its fair market value on the date of distribution.
Okay, that's a lot of steps.
Yeah.
Can you tie it all together with a final example? Show us the corporate gain loss flowing through, adjusting basis, and then the shareholder's final gain loss calculation.
Absolutely. Let's use example 10. XYZ Corp.Corp is an S corporation, and it's undergoing a complete liquidation. It makes a final liquidating distribution of its only remaining asset, a building, to its sole shareholder W. The building has a fair market value of $100,000 and an adjusted basis to XYZ Corp of $60,000. Let's also say that for its final short tax year leading up to liquidation, XYZ had $10,000 of ordinary business income totally separate from the building. And W's stock basis before considering any of this final year activity was $30,000.
Okay, $100K building FMV, $60 basis, $10K ordinary income, $30 starting basis for W. Walk us through it.
Step 1. Consequences to XYZ Corp. The corporation is treated as selling the building for FMV. So XYZ recognizes a gain of $40,000, $100,000 FMV minus $60,000 basis.
Okay, $40K gain recognized by XYZ Corp. What happens to that gain?
Step 2. flow through and basis adjustment for W. That $40,000 gain flows through to W, the sole shareholder. The $10,000 of ordinary business income also flows through. Both of these items increase W's stock basis before we calculate his gain on receiving the building. So W's basis becomes $30,000 beginning basis plus $10,000 ordinary income plus $40,000 gain from building, $80,000. His final adjusted stock basis is $80,000.
Okay. The 40K corporate gain bumped his basis way up. Now, step 3, W's personal gain loss.
Step 3. Consequences to shareholder WW received the building worth $100,000 in exchange for his stock. His final adjusted basis in that stock was $80,000. So W calculates his personal gain on the liquidation as $100,000 FMV of building received minus $80,000 adjusted stock basis. That equals a $20,000 gain to W.
So in the end, W reports the $10K ordinary income, the $40K gain from the S-Corp's deemed sale of the building, and an additional $20K capital gain on the liquidation itself.
That's exactly right. It clearly shows how the gain recognized at the corporate level flows through, increases basis, and then affects the final calculation at the shareholder level. Even in an S-Corp liquidation, there can effectively be two layers where gain is recognized, although the character might differ. Corporate gain flowing through retains its character. Shareholder gain on stock is capital. Hashtag outro.
Wow. Okay. That was an incredibly deep dive into the powerful and, let's be honest, pretty intricate world of S corporations. We went all the way from putting assets in at the start, managing operations, getting profits out strategically, and even handling the complexities of termination and liquidation.
We really covered the life cycle.
Yeah. And we saw how basically every single step can be strategically managed to optimize your tax position, hopefully save you some significant money, whether it's dodging those immediate gains when you contribute property, carefully navigating the built-in gains tax, or maximizing how you deduct losses by managing a parent's hit.
Precisely. And I think the real aha moments, the key insights, often come when you connect these rules that seem separate at first glance, like understanding how your stock basis and your debt basis interact, or the huge difference C Corp E&P makes to distributions, and the power of that bypass AAA election,
Right.
and just how critical it is to protect your S election status once you have it. Getting those connections right, that's the foundation of true tax efficiency with an S Corp. It's about seeing the whole picture, not just isolated rules.
So for you, our listener, the learner, the big takeaway here isn't just memorizing the rules about S-Corp. It's about figuring out how to proactively leverage this unique structure to your advantage. It really hammers home that idea of sophisticated, proactive planning, doesn't it? Not just, reactive tax filing once the year is over.
Exactly. It's about making informed decisions throughout the year.
So thinking about all this, what does it all mean for you?
Yeah, this raises a really important question for you to consider. How might understanding something specific we talked about today, like that bypass AAA election maybe, or the costly trap of distributing depreciated property, or even just the subtle ways basis recovers to allow suspended loss deductions, how might that knowledge fundamentally change the financial strategy for your own S corporation, or maybe one you're thinking about setting up in the future? Because the world of tax, as we know, is always changing. Staying informed, understanding these advanced nuances, and actively planning, that's truly your best defense against unexpected tax hits, and frankly, your most potent offense for building wealth in your business.
That is a perfect thought to leave everyone with. In this really complex dance between business and taxes, the S corporation, when you manage it strategically, when you really understand these advanced rules we dove into today, it truly allows you to lead. You're in control.
Well said.
Thanks so much for joining us for another deep dive. We genuinely hope this knowledge empowers your next move, gives you the confidence to really master your S Corp and save some tax dollars along the way.